So why was it different this time when people start to panic and go, "Whoa, I don't want to be in bonds"? Is that because they say that there's going to be huge amounts of money printing? I'm holding a bond that's paying me out in US dollars, and that's what people are getting a bit fearful of now, isn't it? That they don't want to hold a bond and get paid in US dollars if they're going to be printing 20, 25% more dollars each year and being diluted. Is that kind of the general fears that, or
So, I mean, that's the fear for some people. But in that environment, there was a lot of demand for treasuries at first. The main issue, the actual sell-off, was more mechanical in nature, in the sense that, you know, uh, uh, I think you probably had guests to cover this before, but going into that event, there was about $13 trillion in dollar-denominated debt held outside of the United States, according
mm,
to the BIS. And there are other, things we can add to that. That the number is actually probably higher than that, but that's the BIS's estimate. And so that means that corporations and sovereign governments around the world, many of them have debt that's denominated in dollars, which is tricky because they can't print dollars. That's a foreign currency for them. So that's an obligation that they can't print, and so they have this dollar-denominated debt, and many of them have foreign exchange reserves that they use to settle their debts if need be. And so what we saw, and they hold that in treasuries for the most part. They also, if they diversify, they might also hold it in other currency, sovereign bonds, and some gold and things like that. But a large portion of it is treasuries. And so what we saw was, we had this big, shortage of dollars outside of the U.S. system. Now we also saw in the U.S. system, but that's less severe because the Fed can easily supply, liquidity as needed, but it's harder on the international markets. And so that's where we saw the swap lines open. So trusted, ally central banks can get access to that liquidity. But we also saw that many central banks, they started selling treasuries in order to raise the dollars needed to supply their systems with liquidity.
mm.
And so that is kind of a mechanical force selling. It's not even necessarily a decision like I'm worried about money printing, I'm worried about, the value of the treasury. It's more like I have to pay this bill next month. I need dollars to do it. And I have this big stack of treasuries that I can sell and get dollars. And so you had that kind of forced selling. And then you had hedge funds that, they hold, stocks and bonds. Risk parity basically is you hold a lot of bonds, you hold some stocks, and you leverage it up. But if you start to have both stocks and bonds selling off together while you're leveraged, it means that fund has to say, okay, we have to deleverage now, so we have to sell some of our assets. So they're just mechanically selling bonds as well. So you basically just had a lot of forced sellers, not necessarily people deciding to sell, but that they have to sell, and just not enough buyers at the time to pick up all that slack. So that's where the Fed came in and said, we'll literally buy as much as needed. We'll buy $300 billion a week to reliquefy this market.
Yeah, now that we're in the money printer go brr era, where everyone is just printing a lot of money, and you said that China have stopped buying as many bonds and they've started buying more gold and commodities and those types of things. And I start to question, well, how much longer when country A doesn't know how much money country B is printing? Do they keep selling their commodities? And people say, well, China's bought up too much real estate in Australia, or we're buying too much oil and uranium or whatever it is. All this global trade that's happening. How long does it just keep happening when country A doesn't know or trust country B how much money printer go brewer they're actually doing in the background?
Yeah, and especially, I mean, the way that the game theory works is that, countries start to have a competitive devaluation. So if the U.S. weakens, then Europe wants to go and say, no, we want the euro a little bit weaker too. We don't want the euro to strengthen too much against the dollar, and therefore make our exports less competitive. And then China says, well, now both the dollar and the euro weaken, so we want to print as well, and weaken us, so that our exports don't become uncompetitive. And then the dollar does it again. So you have this kind of round the table devaluation. And historically, if you look at the long term debt cycle, after the zero bound is reached and you start to run into asset purchases, usually the end result of all that is some degree of currency devaluation. So that could be, you can compare it in different ways. So, historically it's been against gold or against hard assets in general. But that would extend also to other commodities. That would extend to real estate. That would extend to assets like Bitcoin. Anything that's kind of scarce. If you have a much larger number of currency units in the system, you end up getting a devaluation of the individual value of each currency unit.
And do you agree that we are sort of very close to that point now? I mean,